It does take us to our talk of the tape, the post-election rally and where these markets might go from here. Let's ask Saira Malik. She's the head of equities and fixed income, the CIO as well at Nuveen. Welcome. It's good to see you out here.
Good to see you. So
how do these markets feel to you? We had this burst post-election. Then we took a little bit of a breather, and now maybe we're in the midst of something else. What do you see?
I think markets are finally finding their footing for two reasons. One is recovery from that post-election hangover after the first week and reaction to NVIDIA's earnings. Now, NVIDIA's guidance wasn't as much as investors had hoped for, but it is continuing this underlying trend of a shift to software stocks. So those are what's outperforming from here. I think, first of all, because budgets that have been spent so much on AI are starting to be pulled back and shifting back to spending on software, and expectations for lower interest rates are good for software stocks. Back to the election, taxes, tariffs, and regulations, and how those are going to impact the markets going forward is what we're looking at.
Do you like NVIDIA here? I mean, if anything, this just shows how high the expectations are, right? I mean, when you're doing, your revenue growth is so enormous year on year, but it fails to meet what are, almost unbelievably impossible expectations at this point.
Well, stock is up almost about 200% year to date. So a lot of expectations in this stock to constantly beat and raise guidance, and we did not get the guidance raise that investors wanted today. Long-term NVIDIA is very strong. Blackwell is going to be huge for them. Spending on AI is going to be big, but you're going to see these periods of consolidation. People are waiting now to say, how are we going to monetize AI? How are we going to see that in clients and corporations' business models? So I think that lull could happen, and now you see software taking the lead here going forward.
You mentioned three things on your mind, that the themes for the new year, if you will: lower taxes, higher tariffs, easier regulations. That against backed up yields. What do I do with that? And at what point is that a problem?
Well, the concern is that those three things are going to cause two problems, which is stickier inflation and an economy that could overheat. I think the jury's still out there, which is why you are going to see this volatility around the Trump trade. It'll work for a while. It'll take a break as people worry about it. It probably depends on what's going to happen with budget cuts. Will regulations cause more M&A? Will taxes cause higher inflation in the U.S.? I think those are real risks that investors need to consider. S&P right now trading at about 22 or so times forward earnings. Last time we saw it higher was in March of 2000, where it traded at 24 times.
I think we know
how that ended. So I think that's a concern.
But is this ending going to be different because of the power of a new administration, the lowering of regulations, the lowering and re-upping of the tax cuts, and all that's going to be more important than whatever higher tariffs do? And by the way, if you look at performance of stocks with higher tariffs, it's not like the stock market did terribly the first time that Donald Trump was president. So why should it do terribly the second time?
I say Trump 2.0 is different in terms of the environment than Trump 1.0. Interest rates and inflation were not at these levels the first time around. So I think that does give us a different ending. I don't think we're going to have the same ending as March 2000, where we have this dot-com bubble, because tech stocks are much more fundamentally strong this time around. So the ending, challenging to say. It's really going to depend on, can this economy continue to perform strongly without overheating, and can we manage inflation? We'll see PCE data next week. Can we manage inflation down to about the target without it reaccelerating again, like it did earlier this year?
Are you dialing back your own expectations of rate cuts? I feel like now we're debating in real time whether December is going to happen or not. It seemed like a formality at one point, but now I hear doubts.
We've been worried about the degree of rate cuts that the market expects for quite a long time. We weren't in the 6 to 7 cut camp at the beginning of this year. December's about a coin toss now, 50-50 chance of a rate cut. And I think the 4 rate cuts next year are in question. If the economy remains at the strength that it is and inflation picks up, I think the Fed's going to have to cut back on rate cuts. That volatility could be dependent now more on the Fed. How will the markets handle this lower degree of rate cuts? Can they handle it as well as they did this year?
The Fed speak lately has been a little bit mixed. Fed Governor Bowman yesterday was pretty hawkish. Now, she's been hawkish, so that's not a big surprise. Goolsbee today was more dovish, I guess. As long as we get some degree of cuts, is that all that really matters? The size of those cuts, the speed at which the Fed cuts is not that important?
I think it depends. How does the economy and the consumer react with those rate cuts? What's been the driver of this economic cycle has been consumer spending, particularly on the high end. If that can continue even with higher interest rates and inflation, then I think all of this soft landing narrative will remain intact. If the high-end consumer starts to fall apart and crack, and we're not seeing that yet, I think we would be more at risk. But another important number is going to be employment numbers coming out at the end of this month, because you saw that last month's payrolls were only up 12,000. We blamed it on strikes and storms, but September payrolls up 250,000. Where are we really in the labor markets is going to be an important factor to watch.